Hey, welcome back, subscribers, to my world of stocks, and welcome back to another episode of Ask Ale, where I take a viewer's question and I make a quick video response to it. And for this one, we actually have another new member in our Discord. This time from Patrick with a star in the name. I actually kind of like that SpongeBob reference there. But he says, "Hey Ale, new member here. If you get a chance, could you please break down how to value stocks in a beginner-friendly way? You often mention that a stock is trading cheaper or more expensive than their peers and the sector, but I don't really know what that means or how you determine that. Maybe you could even do a short video for beginners explaining the basics on how to find that information and what those metrics mean. No worries if you're busy though with other content, but thanks for everything you do." Well, you are very welcome, Pat, and I'm super excited to have you join us in the Discord as well. I actually love this question here because I do get asked this pretty often, so it's probably a good idea to just make a video response for this, especially heading into the new year here pretty soon is sneaking up on us. But yeah, what we'll do here is I'll keep this, like you said, very beginner friendly. I'll just break down for you guys how to quickly value a stock without having to make a bunch of difficult calculations or predictions or any of that type of stuff. And I'll put some chapters for you down below if you need them, but we'll just start first with a quick overview of some of the most basic valuation metrics in case you're not familiar with them. And then I'll show you how to compare a stock to its peers to determine if it's over or undervalued. Just keep in mind though that all of this will be assuming that you've already done the work of researching the company, the business, the products they sell, their financial performance, the markets they operate in. I'm assuming you know all of that stuff already and you like what you see, but you just need to determine now if the actual stock price is reasonable at its current levels. Well, first things first, I hope most of you know this by now, but of course the price per share alone has nothing to do with the actual value of a stock. A $10 stock can still be extremely overvalued, while a $100 stock can still be incredibly undervalued. And it's only when we factor in things like a company's sales, earnings, assets, and debt levels that we start to realize whether a stock is truly cheap or expensive for the price that we're paying, and also in relation to other stocks in the market, which again, I will show you how to make those comparisons later in this video too. But first, to break down each valuation metric, I'm gonna suggest that you head over to Yahoo Finance, where we can type in the name of any stock we want. In this case, we'll just use one that I've been buying a lot of recently in Tyson Foods. So the ticker symbol is TSN. And then we'll click on the statistics tab, which will bring us to this page here, where we have some of the most widely used valuation metrics and ratios all lined up neatly for us in one place. Now, the first one you see here is the market cap, and that's just the total dollar value of the company in the stock market, and it's calculated by multiplying all of the company's outstanding shares by the price of each of those shares. And the reason why it's helpful is because a stock's share price alone doesn't really tell you how big a company actually is or their total value. So the market cap can help fill in some of those blanks for us. And just so you know, I generally categorize market caps into small, medium, large, and mega cap, with small being companies worth anywhere under $2 billion, medium at around 2 to 10 billion, large at above 10 billion, and mega, I would say that's anything around 200 billion or more. Those are really gigantic companies. Now, I'd also mention that smaller sized companies are usually a bit higher risk, while larger ones tend to be a bit safer. Obviously, there's many outliers and exceptions to that, but it's just a general rule of thumb that companies will typically fall into these categories, with Tyson Foods, for example, being a world leader in meat and poultry products with very strong brands and a large market cap of close to $20 billion. So for them, I would personally categorize that as a well-established and fairly low-risk type of company to invest in, not being at very much risk at all, really, of going under or disappearing anytime soon. The trade-off, though, is that smaller companies tend to have much more future growth potential because of their smaller size. But it's not too big of a deal. I would focus much more on just the overall quality of the company and their business rather than its size. I will say, though, that most of my largest core holdings are either large or mega cap stocks that help provide a lot of stability and safety to my portfolio. So it can still be important to consider depending on what you're looking for. After that, though, we do have the enterprise value, which is just a market cap plus all of the company's debt minus their cash. And what it's useful for is to just get a more comprehensive understanding of the company's entire worth, especially for acquisition purposes, because if another company wants to buy them, they would have to take the enterprise value into account because they would also be taking on the company's debts rather than just, the stock price alone. And in the case of Tyson Foods, you can see that their EV is actually quite a bit higher by around 7 billion more than the market cap, which means that they do have a fairly large amount of debt. So you would want to keep all of that in mind too if you're an investor, that this is a company here that does have significant debt levels that they'll need to be paying back over time, and that is something to be aware of. Where things do start to get a little more interesting, though, is in the price to earnings ratios, what we typically refer to as just PE ratios, and these are calculated by taking the price per share and dividing that by the company's earnings per share, basically the profits, what we call EPS, which then gives us a general idea of how expensive the stock is in relation to their profits. Now, the lower that this number is compared to its competitors, the cheaper or perhaps more undervalued the stock is considered. And that's because you're essentially paying a lower price for the company's performance versus their competition or other options in the market. And again, I'll show you exactly how to make those comparisons in just a second. But you should also keep in mind that a higher PE ratio can sometimes be the result of investors willing to pay more money for the company now because they're expected to have higher growth in the future. So the general rule of thumb is that high PE ratios are usually attached to growth-oriented stocks, while low PE ratios are typically attached to value stocks. Again, like with all things that we're talking about today, there can and are many exceptions to this, and we could even argue about what technically makes up a good value or growth type of stock too. But just in the general sense, this is another way that we sometimes categorize stocks, is by how low or high the PE ratio is. Also keep in mind that a stock might have a high PE ratio based on hype that may not be very well justified, while a low PE ratio can also be caused by something being fundamentally wrong with the company's current business or their future outlook. So as always, you want to make sure that you're doing plenty of extensive research regardless on any stock that you're thinking about investing in, rather than just jumping into it blindly based on only a few valuation metrics. You actually want to see if there are any hidden details underneath that you'll need to uncover and be aware of. In any case, the PE ratio is usually broken down further into what we call the trailing PE and the forward PE ratios. Now, when looking at the trailing PE, that just calculates the ratio using the company's earnings from the past 12 months or the last 4 quarters. So it basically tells you how expensive the stock is in relation to how they've performed so far in the past. Now, the forward PE ratio does the same calculation, except that it uses earnings expectations based on analyst estimates for the following 12 months or the next upcoming 4 quarters. And so you can see why some investors would prefer the trailing PE because it's based on actual performance that has already happened, while others may prefer a forward PE because it gives them a better idea of where the company may be headed or how they're expected to perform in the very near future. Honestly, though, while both metrics are extremely valuable and worth considering, I do usually pay a little more attention to forward-looking ratios because I like to see where the company is more so going towards rather than where they've been. But again, both are very important. In the case of Tyson Foods, though, they currently have a dirt cheap forward PE ratio of only around 13, which you'll see in just a second is much lower than the competition. Another hugely important metric, though, and what is probably my personal favorite of all of them, is the price to earnings to growth ratio, or PEG. And the reason I say it's my favorite is because this metric also factors in future growth, usually 1, 3, or even 5 years out based on analyst estimates. And you can calculate this by dividing the PE ratio by the EPS growth rate. Now, in general, a PEG ratio that is lower than 1 is considered an undervalued stock because it means that their expected growth is actually exceeding the PE ratio. So a PEG of exactly 1 would mean that the PE and the company's earnings growth rate are basically equal, and therefore many investors would consider that to be a fair value. While anything above 1 is probably getting a little expensive since you are paying a higher PE than the actual growth rate. I know it's a little confusing, but the best practice here would be to not only look for a stock that has a low PEG ratio, but also just to compare it to the competition. In this case, so I'll just tell you right now that Tyson, sitting at just less than half of 1, is an extremely good value here, and it gets even better when we compare it to the others in just a second. But just to finish off with these last 3 metrics really quick, the same can basically be said about these ones too, that you'd want a ratio of around 1 or less if you can get it. Obviously, it can be higher if the company's worth the premium, like with all valuation metrics really. But overall, the lower the ratio, the better it's going to be here too. And these last 3 consist of price to sales, price to book, and EV to sales. Now, price to sales is useful if a company is not yet profitable because you won't have any profits to judge it on yet and would therefore need to consider sales more, if the PS ratio is less than 1, then that means that you're paying a smaller price than what the company is actually generating in sales, which is typically a good thing. Price to book just replaces that denominator with the company's equity, which is the total assets minus the liabilities, and then we divide that into the stock price, which helps us understand whether or not we're getting, a lot of the company's net assets in return for the price that we're paying. And just like before, a PB of less than 1 is generally considered a great value too. And finally, the EV to sales just uses enterprise value instead of market cap, which in the case of Tyson Foods, the PS ratio is insanely good at less than half of 1. The PB ratio is totally fine at around 1. And then the EV to sales is also extremely good at only around half of 1 too. All right, guys, this is where things do start to get much more interesting, though, is in looking at some comparisons. And to be honest, there's many great websites that you could use for this, and I find new ones all the time, especially depending on, exactly what type of analysis you're trying to run here. But for the sake of just keeping this video as beginner friendly and simple as possible, I'm just going to show you the one that I probably use the most if I'm just kind of trying to really quickly pull up a stock and I just want to immediately see how they compare to a broad range of potential competitors on the most basic valuation metrics. I just need these quick answers. I'll typically use Seeking Alpha. So we go to the homepage there and we have Tyson Foods here on the homepage. We're going to click on the valuation tab and right away we can see all of these awesome comparisons to not only their own 5-year average for each metric, but just as important, we can see them compared to the rest of the sector that they operate in too, which in the case of Tyson Foods, you're talking about one of the absolute cheapest stocks you can get right now in terms of brand, business, and financial strength, especially compared to the price you're paying. Now, by the way, I do typically use the non-GAAP measures. You can use GAAP if you want to, but the non-GAAP just means that these are going to be using numbers that are adjusted for one-time or unusual type of events that will eventually pass. So I just feel that it gives an overall clearer view of the company's core profitability instead of focusing on temporary distractions. And with that in mind, Tyson's adjusted forward PE ratio is over 21% lower than their own 5-year average right now, and it's over 15% cheaper than the sector median, while their PEG ratio is a whopping 67% lower than the sector too. And the same goes for their price to sales as well. So by all accounts, Tyson is trading at an incredible value right now. Now, that's not to say that there isn't good reason for that, as the company has been facing numerous challenges in the macroeconomy, hence why investors are selling the stock and why it's performing poorly. You've got high inflation, high interest rates, not only making their products more expensive, but even the price of feed is high too, which hurts their margins. But to make matters worse, the overall meats market has also been dealing with a ton of natural disasters, one of the biggest cattle shortages in history. So all of that is applying a lot of short-term headwinds and pressure But over time, I do expect these issues to slowly go away. And so with the stock trading at one of the lowest prices, of the past decade, with an insanely cheap valuation and also a very strong dividend, by the way, that has now risen to one of its highest yields ever, I just think it's an incredible value at the moment. By the way, for the dividend, you can also go to the dividends tab on Seeking Alpha and get all kinds of useful information there too. Dividends, of course, are also a big factor when you're considering a stock and at the current valuation. But that is probably another topic for another video in the future, along with the company's balance sheet, income statement, cash flow statement. Those are all separate videos that I can absolutely make for you guys if you want them. Just let me know down below if you do, or if there's any other type of educational video you'd like to see as well. I'd be more than happy to make them for you. Just keep in mind though too that everything we've discussed in today's video are all just tiny little pieces of a giant puzzle. You of course need to do much further research before investing in any company, but I hope that this video gave you at least a little bit of insight for now into valuing a stock, at least at a very kind of surface level, and how to do it quickly. And if you have any questions at all, feel free to drop them for me down below. Or even better, if you want to chat with me and other like-minded investors at any time, then you should definitely consider joining our Discord, which continues to grow larger, and it's a ton of fun. You can get access to that through my Patreon. Link is in the description. But regardless, thank you guys for all of your support. I hope you're all doing well out there, and I will catch you in the next video. All right, thanks again. Take care, my friends. Bye-bye.